Hi folks, Chuck Gibson from Financial Perspective in Pleasanton, California with June 2016's Charts on the Move. In spite of the fact not much has changed from last month, I do have a lot of charts you need to see, so let's get to it. In my first chart, a daily look at the US S&P 500 index, you can see that 7 prior times the range from 2015 to 2135 has stopped it from advancing. A narrow 20-point range and less than 1% of the index value. This level has acted as an impenetrable brick wall each time it hits it. Brick walls can stand without cracking or breaking for a long time. This one has only been in place for 17 months. Is it crazy to think it might be broken so soon? I don't know if it'll hold again, but the entire 17 months can be viewed as a correction. Most times when you talk about a correction, it's very noticeable in a chart. A deep pullback like what happened in 2008. There are a couple of pullbacks in this chart, but the deepest is only 15%. Not the 20% or more that many look for as a correction. So, does the S&P 500 still need a 20% correction before it can move higher? The answer to that question is no, as markets can correct either through a drop in prices or through time. And this market has been doing just that for the past 17 months. Whether the market moves higher right now, or takes another 2 quarters, or not at all, no one knows. But the almost 1.5-year consolidation and 15% decline is more than enough correction, if now is the time. As such, we need to keep our minds open to a bullish outcome and the possibility of a resumption of the bull market. The markets don't like uncertainty, so the one thing for sure is that we are going to live in a regime of elevated volatility for a while. Problem is, it's hard to invest when volatility is this high, so you can either wait till things calm down or you can work into positions over a long period of time. Unfortunately, if you wait until things calm down, it's usually too late as the boat has already left the dock. My next chart is a look at the quarterly U.S. sector performance. The big winner for the quarter was energy, up 9%, followed by utilities, healthcare, and staples. The big loser was technology. If you're a bull, this chart should send shivers down your spine, as it's exactly the opposite of what should be leading in a bull market. If the market is to go higher, we will need to see last quarter's biggest losers, technology and consumer cyclicals, reverse course and once again take a leadership role. Keeping a theme of U.S. sectors, my next few charts are representative of a few of those that are exhibiting strong trends. The first of that is consumer staples, XLP, one of our few remaining core holdings we have not been shaken out of since the market has been consolidating them for the past 17 months. As you can see, it's in a very strong upward rising channel and continues to look very strong. IYR, my next chart of real estate, like the broad market, has been in its own consolidation range for the past year and a half. Unlike the overall market though, it broke out to the upside last week on better than average volume. This classic breakout pattern, combined with a wide base, portend to the possibility of much higher prices. My next chart is that of silver. The beautiful looking bull flag acted as a catalyst for silver to blow right through the long-term red resistance line at $18. The negative divergence that has formed on both the RSI momentum and the MACD, combined with a near-term overhead supply, should slow silver's climb down at best or cause a pullback in the worst case. Once silver eventually breaks through $24 though, it will be a back up the truck level moment for the shiny metal. My next chart of gold looks very good too, but when comparing it against silver, it is less compelling, as it has lagged it by more than 8% this year. Major overhead resistance exists just around the $1,400 level, which should be the real test for the bulls. Both silver and gold would benefit in the near term if price consolidated either by correcting downwards or sideways through time, as it would allow the bulls to rearm, call in support, and get ready for the next leg of what looks like a new bull market. My next chart is that of the regional banks and looks very weak as it has formed lower highs and lower lows. Price also sits below a downward sloping 200-day moving average. In the very near term, like most stocks, it rallied after the Brexit caused sell-off, but the rally so far is weak and has formed a bear flag, warning of a potential for lower prices ahead. The price of the NASDAQ Technology Index in my next chart, like the banking index, has been in a downtrend, forming lower highs and lower lows, in addition to forming a bear flag. The double negative RSI divergence in the upper pane has me concerned of continued weakness rather than strength. If price can't rally, and I mean real soon, it's warning of the possibility of new lows in the intermediate term future. The fact that banks and technology are still in confirmed downtrends while the broader market is knocking on the doors of new highs puts real doubt into the bullish case for U.S. stocks. Until these two sectors can get up off the mat and turn it around, even if new S&P 500's highs are in the near-term cards, any upside will likely be muted. My next chart is that of coffee, a new small addition to client portfolios in the quarter. Coffee is a crazy volatile commodity in a market I normally shun, but couldn't pass up this opportunity as the setup was too enticing. Even though price declined more than 50% in its recent fall, momentum stayed in the bullish zone while price formed a very nice rounded bottom pattern, which, if plays out, will provide a 20% upside target. Moving outside the US, I wanted to take a look at just two markets, Europe and Japan. My next chart is a monthly look at European 600 stock index and should look familiar as I've shown it before. After topping near the $400 level, which has acted two other times as a reversal point, it has declined more than 25% peak to trough and sits right on a major horizontal support. While it is likely early, price is starting to look like it's forming a bull flag. If true and price holds above current support, the potential for European stocks look promising. If not, and price breaks lower, the first target is down at the $280 level. Hopping over to Japan, the Nikkei chart looks ominous and like it might just implode. Lower highs and lower lows confirm the current downtrend, and the most recent lower high formed a head and shoulders topping pattern. If the current 15,000 level does not hold, it could get very ugly for Japanese stocks, as there's no real support until it reaches 10,000 level, which makes it the next potential target should their stocks want to continue southward. To finish this month's video off, I wanted to close with one final long-term 36-year look at the US 30-year bond chart. Wow, that's a mouthful. The longest bull market of any investment in my lifetime, US bonds continue nicely in their upward rising channel. But the fact that we're nearing the upper channel boundary, combined with negative RSI momentum divergence, tells me to expect a pullback in the near future. It should be nothing more than just a standard run-of-the-mill bond correction. There is nothing in this chart signaling the end of U.S. bonds is near. Rather, after the correction, we're likely to see a continued rise in bond prices and falling in bond rates. Bondholders' biggest fear is inflation and rising rates. The fact that the majority of the world is struggling with deflation and falling rates provides the backdrop that U.S. bonds should continue to provide a safe haven for a while. Oh, their day will come, and when it does, it will be a doozy, but just not likely to happen in the near-term future. While it may not be reflected in the charts I presented this month, the investment markets around the world are rather weak right now. There are pockets of strength, but when looking at the whole, it's a sickly mess. Short-term opportunities abound for traders, but for longer-term investors, they continue to be few and far between. For this reason, I continue to hold lots of cash and bonds, and when opportunities do arise that I feel are worthy of client investment capital, I've been managing risk by reducing position size. Sure, it caps the upside when we get it right, but messy markets can make even good calls into losers. While I continue to be open to both bullish and bearish scenarios, if I were forced to place a bet, all my chips would have to be in the camp of the bears. I see too many things right now that look similar to what occurred in 2008, except this time the crisis looks as if it will start on foreign shores rather than here at home. It won't likely happen tomorrow, but there's a storm a-brewing and it has me on edge. Well, that's it for this month. As always, I appreciate your time and your attention and hope you have found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with June's Charts on the Move.